Energy prices. Let's bring in Helima Croft, head of global commodity strategy at RBC Capital Markets. Helima, happy Friday. Thanks for the time. Good to see you.
Thank you for having me.
So we've been putting sanctions on Iran off and on for decades. How do you think this new chapter might be different?
I mean, is it going to be different this time? I mean, Iran is one of the most sanctioned countries in the world. The question is this going to change Iran's behavior? Or do the Iranian leadership believe that they can outlast us at this point, that we want this war to end before they do? I mean, I do think that the double blockade is clearly hurting Iranian oil exports. The question is, what more can be done? Are we really going to go after Russia and China, which help Iran militarily? I mean, that remains to be seen. But again, I think there's a view that Iran believes that they can outlast us.
Here's what the Treasury Secretary Helima said yesterday on the show about what they're going to announce.
If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. And look, we do have control of the Strait.
So, Helima, I mean, this sort of newfound posture, you think it works?
I mean, look, Iran is still firing on ships in the Strait of Hormuz. Yes, the U.S. is escorting some ships through the Omani Channel, but Iran still has clear capabilities to fire missiles at ships, to do drone strikes on infrastructure in the region. I mean, look at what has happened to Kuwait in terms of power plants being hit, desalination facilities being hit. So Iran still has significant disruptive capabilities. So again, the question is, how is this going to change with additional economic sanctions?
Helima, and what about the risk of escalation on the military front by Iran? How are you weighing that and/or trying to understand the risks that still has?
I mean, I think that is a clear risk. I think that's why you still see oil prices elevated, despite the rhetoric that it's open for business. I do think a market we have to pay really close attention to is what's happening to the diesel market. I mean, yes, crude prices are well below historic highs, but diesel prices are at historic highs, and we do not have spare refining capacity for diesel. Our refineries are running flat out. We've had a number of refineries in the Middle East targeted by the Iranians. Ukraine continues to hit Russian refineries. So I think that is the market when it comes to energy to pay very, very close attention to. It's what's happening on the product side, particularly diesel.
And speaking of markets to pay attention to, the Chinese and what has been a significant reduction in their ultimate imports, I guess, of oil. How long do you think that continues? Is that something that we can assume will continue through the rest of this year and onward?
In perpetuity, who knows? I mean, China built significant stockpiles in advance of this war. We drew down our SPR with the Russian invasion of Ukraine, did not refill. We've now taken our SPR below 300 million. The question is, will China continue to provide support to the market by paring back imports? Now, imports have risen from July. August levels are higher. We're not back certainly to where we were a year ago. But let's say we go after China more aggressively for military support to Iran. What if China starts buying again in large quantities? I mean, that would send prices higher. I mean, China has provided a key economic assist to global markets by sharply reducing their crude imports. So the question is, is there a change in their calculations on that?
Yeah, whether they start to refill or even suggest a refill, that would change things. On retail gas, Helima, we talked a lot about it yesterday with Walmart. There was a piece on the tape late last night that we might switch to some winter blends earlier. How much relief could that give us in cents per gallon?
I mean, and it goes to the issue of, are we dealing with issues at the margin? The problem right now is it goes again to the refinery capacity. And we are running everything at full throttle, and there just is not any spare slack in this system when it comes to our refinery. So we're talking about things that might help a bit at the margins, but as long as we have these global refinery outages, we're going to have problems across product markets. Europe has not built a refinery in 50 years. The Middle East has been building refineries. Those refineries have been hit.
So ultimately, when the Treasury Secretary says he thinks that oil shouldn't have popped yesterday and the risk might be mispriced, do you agree? Where do you think prices should be?
Like this price we're at right now, the mid-90s is our basic baseline price for where we think Brent prices should be. given the ongoing outages in the Strait of Hormuz. The Strait of Hormuz is not closed, but we still estimate that we're losing from this war about 8 million barrels a day. And we're relying on China's continued, reduction in imports. So we don't have a breakout, to levels that we saw in 2022.
Although he did say, Carl, that China gets about half of their oil imports from the Strait. So it is in their best interest to help participate in the reopening that the U.S. does. We'll see if that works. Thanks, Helima.